This video is brought to you by Sheath. What's up, Wisecrack? Michael here to prove that we are living in the weirdest and stupidest reality in the multiverse. Let me set the stage for you. The year is 2021. A message board that's been on our radar as the place where dum-dums accidentally lose $50,000 on a $3,000 investment has managed to make hedge fund managers and the top 1% lose it on national TV.
This fair share is a bullshit concept.
That angry man is billionaire Leon Cooperman, and he's crying because a subreddit called Wall Street Bets has cost his hedge fund friends billions of dollars, primarily through buying one key stock, GameStop. In fact, these intrepid Redditors have been on such a buying frenzy that they sent GameStop's share price soaring from a little over $18 a month ago to an all-time high of $483. Now, lots of people have rightly asked questions about what this means for the stock market, for regulators, and for sad, angry billionaires. But we think it's interesting because it poses a fundamental question. Is the stock market what people think it is? So join me for this Wisecrack QuickTake on Gamestonks. And before we continue, I want to give a shout out to this week's sponsor, Sheath. Now, if you watch our Culture Binge podcast, then you may already know that low quality underwear is a chap of mine, which is why I was excited when I learned about Sheath. Sheath boxers are underwear for the modern man. Whenever I'm looking for the perfect boxer, I want nice quality material as well as the ability to keep things cool downstairs. I notoriously run on the hot side, so this is an essential part of my wardrobe. Sheath boxers are built specifically for people like me. Sheath boxers have 3 individual compartments to keep everything cool and comfortable. Traditional briefs get so hot and it can ruin a perfectly good day. But with Sheath's ergonomic design, you won't get the prolonged contact that leads to the buildup of heat and sweat. So if you want to be chafe-free and not have to worry about potential embarrassment all the time, then check out Sheath today. If you click the link in the description or go to sheathunderwear.com/wisecrack and use code wisecrack at checkout, you can get 20% off. That's sheathunderwear.com/wisecrack and use code wisecrack for 20% off. Trust me, you will thank me for this life-saving technology. Now, back to the show. And now a very quick rundown. Why are Cooperman & Co. so outraged? Isn't it good for Wall Street when stocks go up? Well, to simplify things a bit, hedge funds don't only buy stock hoping it goes up. They also place bets if they think a stock will go down. That's called a short. In reality, what investors are doing is borrowing a share, then selling it for what it's worth at the time. Then when it's time to return the share, they go out and buy it back, hopefully at a lower price, and pocket the difference. So if the stock goes down, I make a buck, but if it goes up, I lose a buck. And this is what hedge funds like Melvin Capital were banking on.
These stocks, these companies, they're like crappy companies.
Well, yeah.
Okay.
Yeah, they're terrible.
GameStop share price plummeting because, let's be honest, GameStop is a brick and mortar store in the age of the internet, in the middle of a pandemic, and everyone is still mad about their crappy trade-in policy. But when lots of people short a stock, it gives a weird opportunity for other people to make money. Enter Wall Street Bets. Realizing there was so much shorting going on with GameStop, this plucky band of Redditors tried to create a short squeeze. While that might sound like a new cocktail, it's actually a lot more delicious because it's made with billionaire tears. Oh yeah. Essentially, as the price of a stock goes up, all these short sellers need to buy more stock, even at insanely high prices. Or worse, your prospective losses are so high on your short position that your brokerage firm is saying you've got to close your position now. Essentially, bite the bullet, buy and return the stock, or get the f out. All of this just drives the share price up even further, screwing over even more short sellers and continuing the cycle all over again. And in the case of hedge fund Melvin Capital, they had to borrow nearly $3 billion from their fellow plutocrats to cover their losses, which explains why so much of the 1% are frothing at the mouth.
It's just a way of attacking wealthy people.
God, he really can't help himself. Of course, beyond Cooperman, a lot of establishment players are none too happy about this.
This is populism coming for capitalism.
The app Robinhood, for example, has temporarily stopped users from buying GameStop, and brokerage firms like TD Ameritrade have followed suit. Now, according to Robinhood, this isn't about defending the huge investment firms that they're in business with. It's about the company not having enough money. It would go on to limit trading on other stocks of interest to Reddit like AMC and now even AMD. Meanwhile, our Redditors have gained the attention of the SEC and Congress alike. But under current SEC guidance, it's pretty hard to say what, if any, many regulations Wall Street Bets has violated. While coordinating a buying effort to raise the price of a stock sure seems like illegal market manipulation, as Bloomberg's Matt Levine explains, investors aren't being misled here. It's definitely illegal when you lie about a stock to drive up its price. It's probably not illegal when you buy Times Square ads that say, GME go brr, but we'll leave that to the lawyers. Anyway, how did we get here, Wisecrack? How is it possible that a subreddit can seemingly break hedge funds, especially as a global pandemic and massive unemployment seems to only make them richer? Well, the answer isn't complicated. It just requires us to shift our understanding of what the stock market really is. Many people talk about the stock market as an efficient market. To put it briefly, an efficient market is one where prices are exactly where they should be based on lots of people having little bits of information about different things. An efficient market assumes that human beings are ultimately rational creatures who buy and sell things, rationally. Sure, we might make a few mistakes here and there, but on average, I'll try to maximize my gains and minimize my losses. For example, think about the marshmallow test given to kids. An experimenter will give me a marshmallow telling me that if I wait a whole minute before I eat it, I can get another. Given that information and the fact that I'm not a 5-year-old child, the rational choice would be to wait a whole minute and maximize my marshmallows. Let's go. This is what an efficient market assumes. That given all the relevant information, on average, human beings are going to make rational choices. This means, for instance, that they'll also buy and sell stocks at so-called rational prices. Given this assumption, it's not crazy for hedge funds to assume GameStop's share price is going to go down. After all, it's pretty smart to assume that the Borders books of video games is going to fare poorly in a world dominated by Amazon and digital downloads. But what hedge funds seemingly forgot is that stock markets aren't actually as efficient as they think, largely because people really aren't all that rational. As Nobel Prize winning economist Robert Shiller explains, the idea that people are emotionless calculating Borgs is patently ridiculous.
The idea that people are so optimizing, so calculating, and so ready to update their information, that's true of maybe a tiny fraction of 1% of people, but it's not going to explain the whole market.
And this is especially true when we consider how many Redditors are investing in GameStop, not because they believe it's a strong, underpriced company, but rather because they feel a sense of moral outrage against Wall Street.
I think that what you're seeing is essentially a pushback against the establishment.
But it's not just Wall Street Bets that's coming in and messing up the rational market with their memes. The big banks, hedge funds, alternate asset managers, they're all irrational as well, even if they say they're not.
This belief that it's emotions and people making decisions is quite frankly not true. There's a lot of pressures and flows in this market that aren't ruled by human emotion.
I mean, sure, they can program trading bots and do a lot of math, which is a little more rational than sipping billionaire tears. But there's a whole field called behavioral economics dedicated to proving just how fundamentally irrational our whole financial system is. For example, in traditional economics, there's no reason why the day of the week should affect how the market performs. The market isn't a human being working a 9-to-5 job looking forward to the weekend. But behavioral economics shows us that this isn't true, with stock markets consistently closing higher on Fridays and opening lower on Mondays. Likewise, if I made tens of thousands of dollars on Gamestonks, a traditional economist wouldn't think I'd take that money and put it in a riskier investment. But according to behavioral economists like Richard Thaler, that's exactly what I do, which is why I'm putting all of my money into MoviePass. Guys, this is a joke. Please don't do this. And in case the dot-com bubble taught you nothing, there's no rational reason to buy shares in Pets.com when the company pulled in $600K in revenue but spent $11 million in advertising. But hey, at least they made some sweet ads.
Oh yeah, oh, this is my kind of party.
And sure, GameStop probably isn't worth the billions of dollars the market values it at right now. But that's what an irrational market powered by human stupidity does. And it's not like the Wall Street elite haven't made just as big, if not bigger, mistakes. These are the same people who decided to sell and repackage subprime mortgages in 2008, precipitating one of the largest financial catastrophes in history. You know, that event that essentially doomed millennials entering the job market to live in their parents' basement. Guess at least we got The Big Short, though.
Big bank, small bank, I like to make money.
But you might be asking, where do we go from here? Is GameStop's share price eventually going to crater? Most definitely. Definitely. In the future, are we going to see wild swings in the market powered by Wall Street bets? Probably. But more importantly, should we be upset? And this is where I'm not so sure. If this saga has taught us nothing else, it's that the market isn't this magical, rational entity the finance industry has told us it is. Their fortunes aren't necessarily derived from being smarter or harder working than the rest of us. Instead, the stock market is a lot closer to a casino powered by faulty human psychology. And the 1% have been gambling away, sometimes to disastrous results. Just because a bunch of Redditors are now playing the game too and winning, doesn't mean we should have sympathy for the other people at the table. But what do you think, Wisecrack? Is Reddit ruining the fair and honest stock market? Let us know what you think in the comments. A big thanks to all our patrons for being such a huge support and sharing that juicy stonk gossip with us in our Discord. You know who you are. Be sure to hit that subscribe button like you're trying to buy a share of AMC on Robinhood, and don't forget to ring that bell. As always, thanks for watching. Later. Whoa.